Hey everybody, it's Jay Glazer, and we are bringing you episode 33, just like Patrick Ewing's number of Guidance by Glazer, aka G by G, G2G, whatever the heck you want to call it. But we are back, and we are going to talk about not the sexiest topic in the world, but a very important topic. It's something we promise to be delivering you every once in a while, once a month, once a quarter. I don't know. We'll see how it goes. But we are going to bring you a market update. We got the Q3 statistics in hand, and I'm just going to go through them. I'm going to talk to you about what the numbers suggest, what the numbers are, and then we'll get an understanding of what happened in the last quarter, Q3 2018, and what we can expect moving forward. So I have the statistics here, and I'm going to go through them. I'm going to spin it a little, however, because I'm going to give you my opinion, which is not necessarily always in congruence with, let's say, the writer's opinion. So I'm going to give you the statistics and then give you a little spin. So an important statistic is closed sales, right? How many homes actually sold. And in the last quarter, the good news is we were up 5%. Realistically, though, that's not an accurate reflection of what's happened, because year over year, we're actually down 10% in closed sales. So we've actually had 3,327 closed sales in 2018, which is 10% annually since last year. The biggest drop-off was new development, 37% drop-off in closed sales. Now that's because a lot of the projects that were coming to completion closed, so it's a little bit misleading. But at the same time, new development sales overall, which I'll get into in a little bit, are completely down. We've also seen, and maybe more of an accurate market indicator because it's more, it's a tighter timeline, we've seen a drop-off in contracts signed. So we've actually seen a 33% quarterly drop-off and a 12% yearly drop-off. That's pretty dramatic. That's a significant change in the market, and as I've been speaking about on these Guidance by Glazer videos, a shifting buyer's market, that is probably the clearest indicator of said shift in the marketplace. Another thing we've seen is an escalating days on market. So year over year, we saw a 9% increase in average days on market. So average days on market for the uninitiated out there is essentially how long it takes a home to go into contract or a home to sell. And the reality is we're now looking at an average of 97 days. So that's what? 3-ish months, 3.5 months. My math is amazing, obviously. That's 3.5 or so months. And that's, not really a crazy amount of time, but historically, when you were looking at the peak of the market in New York City, we're talking 7, 14, max 21 days for homes to go into contract. So while it's not dramatic in terms of actual time of market, meaning it's not 6 months, 7, 8, 9 months, a year even, the reality is it's still a drastic change from what we've been accustomed to over the last few years. Now, in my notes here, it says that the reason the market has slowed is because of a concern over new tax implications and a continued belief that prices will reduce further. Now, there are 2 points there, one of which I fundamentally agree with and one of which I don't. Now, I do believe buyers are always trying to time the market, which, if you've listened to any of my videos or have seen any of my posts, if you haven't, sign up for our newsletter on glazerteam.com. Yes, shameless self-promotion, always got to get in there. But so you know that timing the market is foolish. It never happens. No one ever times the stock market, and if you do, you're really most likely either Warren Buffett, newsflash, none of us are Warren Buffett, or you are just an amazing investor. Again, most of us aren't, or you just got lucky. So getting lucky always happens. As they say, a broken clock always strikes twice. So timing the market is foolish. So yes, buyers are waiting for prices to reduce further. I'm not necessarily convinced they're going to reduce that much further, but they might stabilize. So that is true. Buyers are sitting on the sidelines waiting for the market to reduce further. The second point, though, about the concerns over new tax implication, I don't buy that. And here's why I don't buy that. The market is historically cyclical, and we are just in a down cycle, right? A cycle, a circle. If it goes up, it has to go down. So I'm of the belief that fundamentally we're looking at a greater macro implication of just a shift in the cycle. Tax implications, I haven't heard a thing about the tax reform in essentially, I want to say, over 8 or 9 months. So I don't buy that that's the reason. Moving along. Let's see what we got here. We have a market-wide closings. We talked about that. 10% drop in sales. Boring. Next topic. Oh, this is interesting. Co-ops. As you may know, co-ops make up a huge part of the apartment sales in New York City. We have condos and townhouses as well, but the reality is the lifeblood of New York City homeownership is in co-ops. Here's something I thought really interesting. We talk about two different major market segments in New York City. We talk about the sub $2 million market and then the luxury price point of over $2 million. Yes, for those of you in less expensive markets, I know $2 million is a ton of money, and it really is a ton of money no matter where you are, New York City included. But we often break down the market into the luxury market above $2 million and the other market, which is still luxury, under $2 million. Here's an interesting statistic. The sales that dropped the most decline in sales was actually under $2 million. What we always talk about in New York City is that if the luxury market falls, that's the indicator of a shifting market, and that's the thing to slow down the first. But what Q3 told us was that actually $2 million sales were slowing down the most. To me, that's a pretty strong indication that something has systemically shifted in the marketplace, right? If you said, okay, well, the $15 million homes have all dropped, that's kind of assumed and obvious, right? The luxury price point is the first thing, as I said, to slow down. But when the sub $2 million market slows down, that is a little bit alarming. So, my prediction going forward is, yes, if you're sitting on the sideline, it's not a horrible idea. And I think that the market does definitely have room to continue to drop, unfortunately. That being said, it's still an amazing time to buy, as that indication suggests. Another interesting statistic, and this is why, for those of you who unfortunately purchased a lot of new construction over the last 3 years, might want to turn off the phone or turn off your phone or turn off your computer or avert your eyes, is that new development sales have declined 30% year over year and have declined for 3 straight quarters. It's not looking good in the development world. Quite frankly, if you're a developer and you are not paying attention to what's happening in the market, you are either SOL, shit out of luck, or you are too stubborn for your own damn good. Moving right along. This is boring. Let's keep going. Inventory. I talked about this when we opened the segment, but inventory is still interesting. Market-wide inventory experienced the largest percentage change since 2009. That's crazy. That means we basically haven't seen this much inventory since 2009. That's a lot. So essentially we've grown 23%, and we now have 7,300 active listings. So again, yes, buyers are sitting on the sidelines because they're waiting to see what happens in the market, but at the same time, buyers just have a ton more options. They have 1,100 more apartments to choose from this year than last quarter alone, or last year alone. That's a massive uptick. So no matter what price point you're looking in, you simply have more to look at. It takes more time. It's a natural process evolving, because it's when you have more to look at, you're not going to decide as quickly. And if you're not going to decide as quickly, you're going to take more time. Very logical stuff. So inventory is really interesting to see how much inventory uptick we've had. That one didn't go very far. I got to work on my toss. That was terrible. We will wrap up this segment with one piece of wonderful information. Ooh, that was a good one. That was a good one. I want to talk about something positive, right? Everybody wants to end a video on a good note. So one nice piece of information for you is that we saw 6 townhouses go into contract last week, which is the largest total of the year. So yes, the market is not in the greatest place. It's not a seller's market. But at the end of the day, the difference between what I would say 2009 and now is that now the market isn't in a wonderful place, but people are still buying and trading homes. They're selling and buying and selling, selling and buying. Anyway, it's all in the hips. It's all in the hips. Great reference. If you've never seen Happy Gilmore, you need to watch it right now. Anyway, my point here is 6 townhouses is a very healthy number. Townhouse market is historically actually the slowest, so to see 6 townhomes go into contract in 1 week is a good sign. Doesn't mean the market's going to rebound. It just means homes are moving. That is our Q3 market update. We hope you got some good info out of that. As always, we'd love to hear from you on all outlets. At the Glazer team, for those Insta crazy maniacs out there, Instagram is the new normal. I swear I was at Austin City Limits this past weekend, and if you didn't have your phone out, something was wrong with you. It's bizarre. And of course, follow us on Facebook. Glazer team, find us, like our page, chime in. We'd love to hear from you. And drumroll please, our amazing website, glazerteam.com, where you can sign up for our newsletter, which you do not want to miss because it's as riveting as these videos. My hand hurts from slamming this thing. I really made a mess. There's a lot of paper in my office that I now have to clean up. Thanks for joining us, and we will see you next week.